had so many changes, as you might be aware, in the last few years with COVID happening and just tax law changes over and over. But Biden doesn't have a proposal there's anything immediate changing from what we already knew earlier on in the year at this point. So the things to watch out for are still the big thing that everyone's talking about is bonus depreciation is going down from 100% to 80%. And just to back up in case you don't know what I'm referring to, basically when you acquire a large asset, typically you have to depreciate it over X number of years. Bonus depreciation basically says you can write off the entire asset. So that's going to change slightly less benefit. That'll affect real estate greatly, especially cost segregation studies, which we'll probably touch on. So that's the big one to watch out for. As far as, we already had the Inflation Reduction Act that was passed, I think, in September of this year. So it's new, but there's not, for the most part in there, what you're looking at is obviously they hired a lot of, or they're planning to hire a lot of real IRS agents. And so we'll see what they do, what their actual hiring looks like. But the other thing is it was really heavy on energy credits and energy efficiency and everything surrounding that. So the solar credits were extended for both residential and businesses. They were set to start dropping down from 30% credits and phasing down or getting removed completely. Those got extended, on the business side, and I believe on the personal side, those are extended another 10 years out at 30%. So that's a pretty big one. And then there's all kinds of other energy credits in there for both personal residences. If you're upgrading any of your AC systems, hot water tanks, even windows, doors, you may be eligible for increased credits going forward on that. So if you're doing any upgrades that might have some energy efficiency, definitely want to look into that going forward, because that's probably going to be a big target area for this administration for a while. And then one other thing I just wanted to mention for people to keep an eye out on, and this is more of a compliance thing, is that starting in 2024, so really basically a year from now, a little over a year from now, all LLCs are going to have to do additional reporting to FinCEN, which is the financial crimes section of the Treasury Department. And this is a big deal because for foreign reporting, foreign owners have always had to report to FinCEN. Now it's all domestic LLCs, and this is big because if you don't file these reports, they have huge penalties for LLCs. So and their percentages. So I mean, it even applies to states like, if you have an LLC in Delaware, Wyoming, or all those states where you typically don't report owners, you would have to report it to FinCEN, which is a federal organization, but it won't be publicly known, and it's probably going to be going to just a black room that no one accesses unless they have to, sort of thing. So it's more of just a hassle and trying to avoid the heavy, burdensome penalties that they could put on you. So planning wise, knowing that is going to happen, if you're an investor in syndications and you typically set up a different LLC for each of your investments, consider setting up less LLCs for those investments to reduce that burden. If it makes sense, use just one to invest in them, things like that. Just think of ways to lower that burden.
Gotcha. Yeah, that definitely has a lot of impact for me. Same with energy credits, which is good news, but the reporting is bad news for us. Same with increased IRS agent, because that also means potentially more audits for everybody. So that's kind of what I derived from this.
Yeah,
um,
yeah. I wouldn't worry too much about more audits though, hopefully, because I think from everything we're seeing, there's so many retiring that they need to hire more just to replace what they have. And they're so behind as it is, trying to get anything resolved with the IRS for the most part. I mean, if you've gotten notices and just the time it takes to resolve things is so much longer because they don't have anyone, they don't answer the phones, they don't, they're just so backlogged. So
yeah,
will some audits increase? Yeah, but for the very high income, or mostly like estate and gift tax returns are really heavily targeted just because there's more opportunity there. But your
yeah,
average middle income, low income taxpayer is not going to probably see much of an increase in audits, is my guess.
got it. Okay, cool. We're gonna move on to some of the questions that we have. We probably got a whopping 16 of these. So we'll try to get through as many as possible. So what are the most common tax loopholes missed by real estate investors, syndicators? Now we kind of talk about timely opportunities or adversity. Now let's kind of talk about a little bit more generically, what are the things that typically the real estate investor will miss?
Yeah. So first, I wanted to talk about loopholes and just clarify the term because you see it. I mean, I see that term everywhere. And for me, when I think of loophole, to me, that is a mistake that Congress made or Treasury made, and taxpayers are trying to take advantage of it. But the things we're talking about today, these are all intentional benefits that you get as a real estate investor. This was designed intentionally by Congress and the Treasury when these laws were passed. So it's not like you're doing anything wrong. This is actually what you're supposed to do to incentivize these activities because real estate is very capital intensive. So with that, one of the things that changed in the last few years that a lot of people aren't aware of is the qualified business income deduction. I find that I mention that to a lot of people and they're not sure what it is, but essentially this was part of Trump's tax plan in 2018. And what this is for any pass-through entity, which includes single member LLCs though. So this could be something through an S Corp, it could be something through a partnership, it can be a single member LLC, or it can be something that's reported directly on your individual tax return. So on your Schedule C if it's a business, or Schedule E if it's a rental property. All of these can potentially qualify. And what it is it's just a flat 20% deduction off of your income from those businesses. And so how this applies to real estate is that real estate can qualify as a trade or business. So that's huge if you have positive income in some years that you can just get this 20% free write-off. But what some people don't realize is it doesn't apply to, there's one big thing that it doesn't apply to, and that is triple net leases. So if you have single family residence and you don't do any of the tenant does all the repairs, schedules the repairs, and then invoices you or something, or if you have a commercial property like a CVS or a Quick Trip, triple net, lease or ground lease, those typically don't qualify. So knowing that ahead of time, and if you can, structuring those so that maybe you are scheduling repairs or something, so you can get that deduction. That's one item. There's also grouping activities. So for real estate professionals, to be able to offer professional, just to back up, but I'm sure a lot of people kind of are familiar with this term, but a real estate professional is someone that works at least 750 hours in a real property trade or business, and they spend more than half their time in real property trades or businesses. So if it's your full-time job to work in real estate, then you probably qualify. And that's construction, development, property management, being an owner. So all of those items, even a real estate broker, All those items qualify as real estate activities. So if you spend all that time in those activities and then you also invest, so in syndications, because we're talking about syndications too, so maybe you have some activities on your own and then you invest, well, you probably don't materially participate in all those limited partner investments. So the only way you can use those to offset your other activity is you have to make an election and group them so you can take those deductions. So it's important to be aware of that grouping election and what it means to be a real estate professional, how you can take advantage of it. Really important distinction too, I mentioned brokers, real estate brokers as qualifying. Agents do not qualify typically. So if you're just a licensed agent selling real estate, probably don't qualify as a real estate professional. But if you're the broker and you have your broker's license, you do qualify. For some reason, the court's made a distinction between those two. So that's an important one that some people don't catch and might miss. And there's really a lot of other things. I mean, a lot of people, I'm surprised, are still not doing cost segregation studies all the time. So a cost segregation study is essentially taking advantage of accelerated depreciation deductions. So generally speaking, if you buy a rental real estate and it's residential, you take the cost after removing the value of land, divide it by 27.5, and that's your depreciation deduction each year. Well, the cost segregation study takes that asset and it breaks it down into all the components that won't last 27.5 years. So your carpeting and cabinetry, countertops, the asphalt in the parking lots, maybe even the sidewalks and rails and exterior lighting, swimming pools, some of the landscaping, all these items can be broken out and just expensed essentially, instead of taking it over time. And so I see a lot of people that still aren't taking advantage of that. And I think the reason, there's different reasons, but most of the time it's pretty advantageous. That's a big one. So those are just a couple of things that people miss sometimes, but I think there's a lot more than that, but we don't have all night.